Hello everyone, I'm Stuti Agarwal and welcome to Invesfinc Advisors channel. So in the last video, we talked about the basics of derivatives. So for this video, we wanted to go a little deeper into options. So to start trading in options, it is important to understand the Greeks so that you can determine if the premium is undervalued, overvalued, or rightly valued. So let's take a deeper dive into the factors that determine the value of an option premium. So these are the 5 types of option Greeks: delta, gamma, vega, theta, and rho. Delta is determined by the spot price and the strike price. Gamma is determined by the delta. Vega is determined by the volatility. Theta is determined by the time to maturity. And rho is determined by the rate of interest. We usually take rho as a constant value. An easy way to remember this is by the initial letters of these 3 with the corresponding. So coming on the first one, delta basically measures the change in the option price when the stock price moves. So over here, we have taken 2 scenarios into consideration, both for which the spot price is at 36,000. For the first one, the strike price is at 35,000. And for the second one, the strike price is at 36,500. For this one, the call option is ITM and the put option is OTM, and vice versa for the second scenario. So as you can notice over here that the delta value is different for both the call option and the put option. This basically means that with an increase of 1 rupee in the underlying, the call option would go up by this amount and the put option would go down by this amount. Positive delta sign basically denotes the positive correlation with the stock price. You can also notice the huge difference between the delta value of the ITM call option and the OTM call option, and same with the put option. So ITM options basically have a higher absolute delta value as compared to the ATM options and the OTM options. In conclusion, we can say that the OTM options have a delta value of less than 0.5, ATM options have a delta value of near about 0.5, and ITM options have a delta value of more than 0.5. Second one is gamma. Gamma basically measures the change in the delta when the stock price moves. So over here, we have taken the delta value and gamma value, which is 2 months before the expiry. And at this one, the delta and the gamma value is 1 day before the expiry. Notice the huge difference between the delta and the gamma values. Gamma is the highest at the money in both the cases. Gamma is the smallest for deep OTM and ITM options. Gamma is positive for long options and negative for the short options. Gamma is basically the difference between the delta values of different strike prices. The third one is Vega. Vega basically measures the change in the option price when the volatility moves. This basically means that when the volatility increases by 1%, the call and the put options premium would go up with the amount of Vega. So over here, we have taken the spot price as 36,000 and the strike price as 35,000. The Vega value is same for the call option and the put option. This means that the value of the premium would go up by this amount, even if the underlying does not move. Then we have theta. Theta is the decay in option price every day as the expiration gets nearer. It is the option seller's best friend. It signifies the time value. Greater the time to expiration, larger is the theta value. So as we know that the premium of the option consists of the intrinsic value, time value, and the volatility value. Vega signifies the volatility value and theta signifies the time value. So the OTM options consist of only the time value and the volatility value. So if the option expires OTM, the volatility value and time value would also come down and eventually the option expires worthless. This is the option chain. So on the left, we have the call side and on the right side, we have the put side. These are the strike prices that we can trade on. This is a chart for Bank Nifty. So the LTP basically determines the premium amount that has to be paid. And as we know that the lot size for Bank Nifty is 25. So if we multiply the premium amount with 25, that would give us the minimum amount that can be traded. OI is the open interest, which basically means the open contracts in the market which have not been closed yet. This works on a cumulative basis. Change in the OI is basically the traded contracts in a day. So that's it for this video. If you like it, do give it a thumbs up and share it with your friends. And happy investing. Thank you for watching.